Okay, I'm going to start with what I consider to be the main issue in which clients approach us in regards to planning with the family home, and this is inheritance tax. Now, as you'll hopefully be aware, a client cannot simply change the named owner of the property at the land registry or effectively give away their property but continue to living it rent-free in order to mitigate inheritance tax. This just simply doesn't work. And we often come across scenarios where clients have either done so already or attempting to do so in order to avoid or significantly reduce their inheritance tax bill. This tends to be what happens when you take advice on social media or maybe in the pub. And this is just a capital gains tax issue. Now, capital gains tax is a tax on profits or basically hypothetical profits that are made. So, i.e., the difference between the purchase price, and that includes all the costs of purchase, perhaps including legal fees or stamp duty, and the value at the time of disposal. So that would include, obviously, the sale costs, or the sale proceeds, I should say, at the time of disposal, less the costs of sale. So you take off your estate agent's fees maybe, or the legal fees. Now, the first of these risk factors is that of bankruptcy. As I said earlier, this could be of the client themselves or the recipient. And in terms of the client themselves, if they're made bankrupt, this could lead to the trustee attempting to recover those assets, of course, and help meet the debts and the needs of the creditors. Perhaps more risky, or usually of more concern to our clients, is where the recipient of the property perhaps becomes bankrupt. So in that case, we've got a risk that the property will be lost to Bob and June in our case study,